Think back to your very first week at your current job. You were handed a massive stack of onboarding paperwork. Or maybe you just clicked through 50 different digital forms. Right in the middle of all that chaos, there was a box. It asked if you wanted to auto-enroll in the company retirement plan, usually defaulting to a random 3% into a target date fund you had never actually researched. You checked the box. You felt responsible. And then, you completely forgot about it. Most W-2 employees treat building wealth like an automated background process. You assume that because a tiny slice of money is quietly leaving your paycheck every 2 weeks, the system is going to take care of you. You blindly trust that the financial industry has your best interest at heart. They don't. The executives sitting behind luxury mahogany tables didn't build the default settings in your corporate retirement plan to make you wealthy. They designed them to extract maximum fees and keep you exactly where you are, trapped on the treadmill at every level of your career. Today, we are taking you off autopilot. We are going to strip away the corporate mystery and look at the brutal, unarguable math of building a portfolio from scratch, the free money baseline. When most people decide they finally want to get serious about investing, they immediately overcomplicate it. They assume the secret to wealth is glued to a multi-monitor setup, day trading penny stocks, analyzing quarterly earnings reports, or trying to predict the next massive tech boom before anyone else. Listen to me. The very first level of building wealth has absolutely nothing to do with picking the perfect stock, and it has nothing to do with your intelligence. It is entirely about stopping the financial bleeding and aggressively taking what already legally belongs to you. We need to talk about the employer match on your 401k. Most employees view the company match as a nice little corporate perk. They treat it like free coffee in the break room, a bonus to take advantage of only if they feel like they have enough spare cash left over at the end of the month. You need to violently reframe how you look at this system. The match is not a perk. It is a fundamental negotiated part of your total compensation package. It is money you earned the exact second you clocked in on Monday morning. Let's look at the undeniable math of what you are actually walking away from. Imagine you make $70,000 a year and your company offers a standard 5% match. If you contribute 5% of your own paycheck, your employer legally has to hand you $3,500 in pure, raw cash. That money drops straight into your portfolio. In the high-stakes investing world, success is measured by return on investment. The smartest, most ruthless hedge fund managers on Wall Street will work 100-hour weeks, deploy supercomputers, and risk billions of dollars just to scrape together a 10 or 12% return for the entire year. Your employer is literally offering you an immediate, risk-free, guaranteed 100% return on your money. You put in $1, they instantly hand you $1. There is absolutely no catch. It is the only guaranteed double up you will ever experience in your entire financial life. And yet, millions of W-2 employees leave this money sitting on the table because they feel the squeeze of the present moment. They choose to keep a slightly larger paycheck on Friday, completely blind to the catastrophic long-term damage they are inflicting on their own net worth. Let's extrapolate the true cost of that decision. That $3,500 is not just a one-time loss. If you leave that money behind, you permanently lose the decades of compound growth attached to it. That single year's match invested in a standard index fund and left alone for 30 years would have grown into over $26,000. If you ignore the match for your first 10 years in the corporate world, you haven't just missed out on 35 grand. You have essentially robbed your future self of hundreds of thousands of dollars in compounding wealth. When you fail to contribute up to the match, you are mathematically volunteering for a pay cut. You are effectively walking into the HR office, sitting across from your boss and telling them you think they are paying you a little too much this year. You are handing your own salary back to a massive corporation just so you can have a little more spending money for the weekend. Here is your exact, non-negotiable mission for tomorrow morning. You pull up your company portal. You log into your retirement provider. Whether that is Fidelity, Vanguard, or Charles Schwab. You locate the contribution settings and you adjust that slider to hit the exact percentage of your company match. If they match 4%, your contribution is 4%. If they match up to 6, you contribute 6, not a fraction of a percent less. This is the absolute baseline of your financial survival. You do not make another move until you are claiming every single dollar that has your name on it. Escaping the fee trap. Let's talk about the exact people managing the default funds in your retirement account. Your life at every level of the corporate ladder is being quietly monetized by a system that relies entirely on your sheer exhaustion. The executives sitting behind heavy mahogany tables on Wall Street absolutely love middle-class W-2 employees. They do not love you because you are a savvy investor. They love you because after a 9-hour shift, an hour-long commute, and cooking dinner, you are simply way too tired to read the fine print. And because you don't read the fine print, they are legally allowed to siphon massive, life-altering stacks of money directly out of your future through something called an expense ratio. When you look at your 401k lineup, you will usually see a list of actively managed mutual funds. They have incredibly prestigious-sounding names. They promise that highly paid financial experts are actively buying and selling stocks on your behalf to aggressively beat the market. For this incredible service, they charge you an annual fee. Usually that fee sits right around 1%. To the average W-2 employee, 1% sounds like absolute noise. It sounds like a rounding error at the grocery store. You think, sure, take a penny out of every dollar, who cares? I just want someone else to handle this stress for me. We need to sit down and run the brutal, unarguable math of what a 1% fee actually does to your life over a 30-year career. Let's say you grind for years and build up a portfolio of $100,000. You continue adding a simple $500 a month for the next 30 years. Let's assume the global stock market delivers its historical average return of roughly 7% after inflation. If you invest that money in a fund with virtually zero fees, the math of compound growth takes over. By the end of those 3 decades, your portfolio will explode to roughly $1.3 million. You have successfully bought your freedom. Now, let's run the exact same numbers, but we apply that tiny, seemingly harmless 1% mutual fund fee, because the financial firm is skimming 1% off your entire total balance every single year. Regardless of whether the market goes up or down, your actual net return drops from 7% down to 6%. Over 30 years, that portfolio doesn't grow to $1.3 million. It stalls out at roughly $900,000. I want you to really hear what I just said. That microscopic 1% fee just vaporized $400,000 of your money. It secretly ate nearly 30% of your total potential portfolio growth. You woke up early. You sat in morning traffic. You tolerated the toxic office politics. You took all the financial risk with your own hard-earned paycheck. The global stock market generated the actual returns, but the guy in the custom suit, sitting in an air-conditioned skyscraper, just stole a third of your life's work for doing absolutely nothing but handing you a glossy corporate brochure. You are literally funding their luxury lifestyles, their private schools, and their generational wealth with the raw hours of your life. And the absolute worst part of this entire trap: statistically, over 90% of those expensive, actively managed funds actually perform worse than a basic, unmanaged index fund anyway. You are paying a premium luxury price for a mathematically inferior product. This ends today. You have to shut off the valve and stop the bleeding. Your immediate actionable step is to run a brutal audit on your 401k allocations. Log into your provider's portal and find the document labeled Fund Performance and Fees. You are looking for a specific column called the expense ratio. If you see an expense ratio of 0.5%, 0.8%, or anything sitting near 1%, you are being robbed in broad daylight. You need to dump those actively managed funds immediately. You are looking to switch your money into a low-cost S&P 500 index fund or a total stock market index fund. These funds are run by algorithms and computers, not expensive Wall Street managers. Because there is no human overhead, their expense ratios are usually around 0.03 or 0.04%. They are practically free. By simply taking 15 minutes on a Sunday afternoon to click a button and move your money from an expensive mutual fund to a dirt-cheap index fund, you instantly reclaim hundreds of thousands of dollars of your own future wealth. Fire the corrupt manager at the mahogany table, keep the stacks of money for yourself, and let the raw math of the market actually work for you. The tax shield. As you climb the corporate ladder, you're going to notice a very painful reality. The harder you work, the more the government punishes you. Every time you get a raise or a promotion, your tax bracket creeps up. You're forced into a silent partnership with the IRS, and they take their cut of your labor before the money ever even reaches your checking account. But when it comes to building your retirement, there's a completely legal, mathematically undeniable way to lock the government out of your wealth forever. Let's look at the raw numbers. Say you aggressively invest $500 a month from the time you're 25 until you hit 65. Through the sheer force of compound growth, that money explodes into roughly $1.2 million. If that money is sitting in a traditional 401k, you don't actually own all of that $1.2 million. With a traditional account, the money goes in tax-free. That sounds great today, but it's a trap for tomorrow. The government is just patiently waiting. When you finally retire and go to pull that cash out to live on, they are going to tax every single dollar of that massive growth. They let you plant the seed for free, but they demand a massive cut of the final harvest. You will easily lose hundreds of thousands of dollars simply paying taxes on the back end. This is where we introduce the ultimate defensive weapon for the W-2 employee, the Roth IRA. A Roth individual retirement account flips the tax code entirely upside down. With a Roth, you invest money that has already been taxed. You pay the taxes on the seed today, when the dollar amount is still small. But here is the magic. Because you already paid your toll at the front door, every single penny of growth inside that account is completely, 100% tax-free. When that $500 a month turns into $1.2 million, you keep every single cent. The government can't touch it. You could pull out $100,000 a year to fund your retirement lifestyle and legally report $0 in taxable income to the IRS. Here is your exact, unbreakable order of operations. You don't just blindly throw all your extra money into the company 401k. Step 1 is hitting your exact employer match, because you never leave free money on the table. But the exact second you hit that match, you stop. You take your next available investment dollar, and you route it directly into a Roth IRA. You focus all your energy on maxing that Roth account out every single year. You build the tax-free shield today. So when you finally walk away from the 9 to 5, your money belongs exclusively to you, ignoring the noise. Let's talk about the absolute circus that plays out on your phone screen every single day. You open up social media, and you are immediately bombarded by 20-something influencers standing in front of rented sports cars, flashing volatile graphs of crypto tokens, meme stocks, or complex options trading strategies. They make it look effortless. They look directly into the camera and tell you that if you just buy this specific coin or learn this specific chart pattern, you can quit your job by next Friday. This is financial entertainment disguised as education. It is intentionally engineered to exploit your exhaustion, triggering a toxic combination of FOMO and raw greed. When you're trapped in the 9 to 5 grind, the promise of a fast exit is incredibly intoxicating. The social media platforms want you addicted to the screen, and the flashy retail brokerage apps want you constantly buying and selling because they monetize the volume of your transactions. They have successfully gamified the destruction of middle-class wealth. When you execute a trade on your phone, digital confetti drops down your screen. It feels like a casino game because under the hood, that is exactly what it is. Let's look at the actual unarguable math of trying to beat the market. Decades of academic research track the performance of individual stock traders, and the numbers are devastating. Over any given 5-year period, more than 90% of active day traders lose money. Let that number sink in. These are professionals who do this full-time. They have advanced finance degrees, they have supercomputers, they have direct fiber optic connections to the exchanges, and they spend 12 hours a day analyzing data. And 9 out of 10 of them still fail to beat a simple, unmanaged index fund that requires zero effort. Now imagine your odds as an exhausted W-2 employee, sitting in your break room, trying to execute trades on your smartphone during a 15-minute lunch break based on a tip you saw on a video forum. You are walking onto a battlefield armed with a plastic spoon against invisible Wall Street algorithms that execute trades in microseconds. You are a lamb walking straight into a slaughterhouse. Every single time you panic sell an investment because the nightly news predicted a recession, or you buy into a hyped-up asset at its absolute peak, you are handing your hard-earned salary directly to institutional market makers. Real wealth building is not a high-speed chase. It is incredibly, wonderfully, beautifully boring. It is the financial equivalent of watching paint dry or grass grow. You do not need to read the financial news headlines. You do not need to check stock tickers every hour. Your assignment today is to go to your phone right now and delete every single flashy trading app that treats your life savings like a video game. Shut down the noise entirely. You automate your broad market index fund purchases so they execute quietly in the background, twice a month, completely insulated from your daily emotions. You let the market do the heavy lifting. You stay completely blind to the daily panic of the news cycle, and you let the raw physics of time compound your freedom. Your life at every level of compounding. When you first start investing, it feels incredibly discouraging. You do the right thing, you set up your automatic transfers, you check your account after a solid year of discipline, and the number has barely moved. You put in thousands of dollars of your own hard-earned sweat, and the market gave you back a few $100. It feels like you're pushing a massive boulder straight up a steep mountain. Most W-2 employees quit right here. They look at the slow progress, they assume the system is broken, and they go right back to blowing their paycheck on weekend convenience. But you have to understand the underlying physics of compound growth. The legendary investor Charlie Munger famously said that getting together your first $100,000 is an absolute nightmare. It's a grind, but you have to do it. You have to do it no matter what it takes. Let's look at why that exact number is the permanent turning point of your financial life. Getting from $0 to $100,000 is brutal because it relies entirely on your human labor. If you invest $10,000 a year, it'll take you roughly 7.5 years to hit that 6-figure mark. And out of that $100,000, roughly $75,000 of it came directly from your own paycheck. You did almost all the heavy lifting. But once you cross that line, the physics completely flip. Going from $100,000 to $200,000 takes a fraction of the time. Why? Because you're no longer pushing the boulder alone. Assuming a standard 7% return, that first $100,000 is now generating $7,000 a year just by existing. Your money is now working a part-time job right alongside you. It doesn't sleep, it doesn't call in sick, and it doesn't pay taxes if it's in your Roth IRA. By the time you hit $300,000 or $400,000, your portfolio is generating more cash every single year than you could possibly save from your salary alone. And eventually, you cross the ultimate threshold. Your money starts making more in a single year than your actual corporate paycheck. That is the exact moment you buy your freedom. The boulder has reached the peak, and now it's rolling down the other side of the mountain, picking up speed entirely on its own. So here is your final mandate. You need to treat the race to your first $100,000 like an absolute survival mission. It is a sprint. You cut the fat out of your budget. You negotiate the raise. You skip the expensive luxury vacations for just a few years. You aggressively shovel every spare dollar into your broad market index funds to cross that 6-figure baseline as fast as humanly possible. The beginning is brutal, but once you cross that line, the math takes over, the corporate squeeze loses its grip on you, and you finally buy back the rest of your life.